Sup, welcome to Tobes Trades. It is March 5th, 2021, and is the dip over? Let's see. Let me pull up the chart real quick. Here we go. Alright. So, what happened today? It was beautiful. It's exactly as I planned. So, earlier at around 8:30, we posted the jobless claims numbers, right? It was fantastic. We have 400K more jobs than expected. That's insane. Most of them coming from restaurants. It shows the economy is opening back up. But immediately after that, the 10-year spiked to 1.6. Not sure if it shows here, but yeah, right? So at 8:30, whatever, there's no pre-market for 10X. It's not showing, but at 8:30, 10-year jumped to 1.6%. It was insane, and correspondingly, the Qs dropped. However, for some reason, it climbed up. Right? It was up like 2% almost pre-market. It was kind of insane. So at that point, I did take some of my existing puts off the table, but I still kept some because I expected this could be a false pump to draw some buyers in, and then so we can flush them out later. That's exactly what happened. I exited the rest of my puts around around like 11, right? When like this bullish engulfing candle formed, and then from that I instead entered into some calls because it seemed like it was taking forever to break 300, right? And it was naive of me to think this was the bottom because, as you remember, I clearly drew this line, right, from a long time ago. If you look, this is the same line as this key support level, right? Look at this support level from September 3rd, from October 12th, and November 6th, the election, and also here, 12/11, right? It's a very, very solid support point to bounce at. And that's exactly where it bounced. However, I thought 300 was a psychological level, so I sold my puts and spot calls from then. And after that happened, this flash, I was like, damn, fuck me, man. And then I waited for a bit. I was kind of busy, so I took my eyes off the market. And guess what? It did bounce exactly at this support line we drew. And ever since then, the market's been going on an upward trend and going even above the pre-market highs, right? As you see, currently we're up 1.6%. And I'm going to take off this channel so we can take a look at the daily candle better, right? This is the daily candle. Look at this hammer. Look at this beautiful hammer, right? We were down here at one point, and then today, intraday, it went all the way back up and more, right? This very, very beautiful hammer. It shows that at least currently we have a very, very short-term consolidation point, right? So is this gonna go straight back up? Probably not. But is it gonna keep going down? Most likely not, right? Very, very small chance of going down. Today's a very, very beautiful hammer, and it's a Friday. Fridays are usually weak, right? Especially into market close, Fridays are weak. And even then, into market close today, we bounced all the way up, right? We were down like 3% at one point. We went like 5% intraday. It's amazing. So where does that put us now, right? So if you look at this trend line, so it seems like we are bouncing correctly at both the horizontal support and the long time upwards trend line. And I'm gonna turn on the indicators so we can look at the moving averages as well, right? We have the 200-day is not close. That's what I'm worried about. Whether or not this rate issue will turn into a very, very big fear, because currently it does instill some fear, right, of course, within people, right? There's a lot of fear going on, and that's what led to the sell-off. However, is the rising rates that important of an issue, right? That's where the key question lies. How important is it? Jerome Powell, during his meeting yesterday, didn't seem like to think it was a big deal, right? And even if it were the big deal, of course they will implement yield curve control, right? It's kind of a different type of quantitative easing. Quantitative easing is setting a set amount of bonds, treasuries to buy each month, whereas quantitative easing focuses on a rate instead. They want to buy however many treasuries necessary to keep a specific rate level, right? So I expect a lot of people expect Jerome Powell to implement the yield curve control, as it is supported by over 70% of the Fed members. But the key question is, do we even need it? Because the 10-year right now is still at 1.6%. It's nowhere even near the 2.1%, like supposedly theoretical equilibrium 2%, and we're not even close to that. And even then, we have great job numbers, right? So one argument for great jobs numbers is that the bears think, oh, if the economy is going to do so great, then perhaps the Fed will take away the quantitative easing promise and take away the low rates. Because currently, the Fed promises low rates until the end of 2022, right? End of 2021, a bit of 2022. However, if we do have really, very great job numbers, then perhaps they will want to push that earlier, right? So we can see rising rates earlier. But it seems like Jerome Powell believes that won't be an issue at all, and that's why the market is rallying, right? So people think, for those who think this is the big ones, it's 2020 all over again. Trust me, it's not, right? This is just fear in the market paired with overvaluation in tech, right? What goes up must come down, and it's a regular correction. It's bigger than like a typical like weekly, bi-weekly correction. It's much larger, but we are sitting comfortably at key support levels, right? And the issue doesn't seem to be too big. However, if you want something to note for next week, the Fed is auctioning off a variety of treasuries, right? I think they're auctioning off the 3-year treasuries on Tuesday, the 10-year on Wednesday, and the 30-year on Thursday. Something to look for then is whether or not there are buyers. There's demand that buy up the treasuries, because right now the bonds market is in free fall, right? That's why we see the rates jumping up. However, if we do see all the treasuries put up for offering being bought and being sold, then there should be nothing to worry about, and we could see the market slowly rally up back to normal levels, right? Of course, I mean, if it doesn't go well, we could see further pain until Papa Powell does decide to do something. But just a bit of update on my play. You guys saw this in the beginning of the video. I am up. As you see, I bought this today, right? Total return the same as today's return. I'm up 22%, even though the call is only up 10%. Because remember, I bought around here, right? About around here, this level, 19.68. Is that right? Yeah, 19.74. I bought around here when I thought it was gonna bounce. And it kind of did, but it sold off again into the actual support level, which I should have waited for sure. I missed out on money on both continued action down on the downside from my SQQQ calls, right, which I sold at the same point as I bought the SQQQ calls. But still looking good. We're up 22% on our calls, right? We put in around 8K. We're up almost 2K. Looks pretty good. I am going to be holding this over the weekend. I'm going to be selling half my position, of course, to always take profit, and then writing the other half into next week, which I expect to be, certainly less downside, but perhaps not immediate upside. We could see some sideways trading action, price action for quite a while, because, even at the end of the day, it is still a big drop, right? And the market does need time to consolidate a base and eventually build up confidence even more to go for the next leg higher. But I think this is healthy, and if the bonds do get bought up and it doesn't turn into a huge issue, we should see some recovery, right? I am long QQQ as of currently, and you should too, right? And peace out. Thank you for watching the video. Remember to like, comment, subscribe. See you next time.